Hello and welcome to this month's market update. Today I'm joined by KC Lowe, Senior Consultant in our Capital Markets and Asset Allocation team. KC, welcome.
Thanks, Phil.
So obviously it continues to be a very interesting time in markets and the global economy. More recently, there's been a lot of focus on this concept of recession. Are we entering a recession? Are we in a recession? What are your thoughts on that topic?
Yes, as you said, there's been a lot of talk and expectations about a looming recession, particularly in the US. So one thing to keep an eye on is the economic growth or GDP data release, which came out recently in the US for the June quarter. And in that report, the US economy has shrunk by 0.9% on an annualized basis. And this is the second consecutive quarter where there's been negative growth for the US economy. And that's usually the technical definition for economic recession. So recession being the economy is shrinking rather than growing. But if you speak to a lot of economists in the US, they'll say that perhaps it's still too early to label the current situation, the current period as a recession, just because of how unusual the environment is. And it's unusual because, yes, the headline economic number is shrinking, but you still have a very strong labor market in the US where jobs are still being added into the economy. And if you look at more timely measures or timely data points, like job openings, job hires, those sort of things, it's at very, very strong levels right now in the US and nowhere near recessionary levels. So still probably a bit too early to call a US recession. And so linked to that is the Federal Reserve at the most recent meeting have announced another 0.75% hike in their own cash rate. So it's an unusual situation because central banks typically aren't increasing interest rates when the economy is shrinking because that's not very supportive, but they're doing it because inflation continues to be a problem there and also across many countries around the world. So they've increased interest rates because they focus on that inflation component. So current US cash rates are at around 2.25 to 2.5% range. And in terms of market expectation, it's that the US cash rate will finish the year at around or above 3%.
You mentioned, the Fed. We've also seen a number of other central banks start to move, somewhat aggressively in tightening policy, whether that's the Bank of England, the Reserve Bank of New Zealand, the Bank of Canada. But we're also seeing moves closer to home with the RBA. Can you talk us through what's going on there?
Yes. So the Reserve Bank of Australia at the most recent meeting has continued to hike interest rates. So they've increased it by another 0.5%. So the current cap rate in Australia is 1.85%. So it's increasing like most central banks around the world. But when you dig a bit deeper and look at the statements, some of the key factors that the Reserve Bank have mentioned in terms of what's driving this slowdown in the global outlook, they've highlighted four key factors. The first being the pressure on real income from higher inflation domestically, but also globally. The tightening of monetary policy across a number of countries, as you mentioned, and the Russia's invasion of Ukraine, which has had flow-on impacts on agriculture goods, supply chains, and inflation more broadly. But also the last factor they mentioned was the COVID measures, otherwise known as the zero COVID policy that's currently in place in China, which also has an impact on supply chains globally too. So those were sort of key factors that the Reserve Bank have highlighted that's driving growth outlook down globally. But in the statements, the wording in there has also changed a bit, which has suggested that maybe the RBA is getting close to the point where they might be reducing the size of the rate hikes from 0.5% to 0.25%, which is typically the size of hikes they usually use. Or perhaps maybe they're getting close to the point where they might take a pause in the hiking cycle just to assess its impact, because usually there's a lag in when rates increase and the impact on the economy. So because of those change in wording, expectations in markets have shifted a bit post the most recent meeting. Expectation is still for the cash rate to end this calendar year at around 3%. But in terms of the peak that it gets to next year, it has shifted from about 3.5% down now. So there's been some lowering in expectations for next year. So as I said earlier and also in previous videos, central banks are increasing interest rates because they're trying to combat inflation, particularly focusing on trying to moderate the demand side of things. So one way for us to keep track of how demand is moderating is looking at the Commonwealth Bank's credit card and debit card spending data. So that's a weekly data release, so it's much more timely. And when we look at that measure, it does look like consumer spending has started to moderate, particularly since May. So if you think back, that was around the time when the Reserve Bank started to hike interest rates. So it is starting to flow through to consumer and spending, consumer demand. What could be of interest is that the impact on consumer spending is not equally spread out. We've seen that non-discretionary spending has held up quite well, at least in nominal terms. It probably has declined a bit in real terms just because inflation has been very high. But it's really the discretionary spending side of things where it has turned down a lot more. So that's something to keep an eye on.
Yeah, it's a difficult circumstance that central banks are trying to navigate, as you said, with perhaps further moves higher to go, but also the consumer becoming a bit weaker. So it'll be interesting to see how they walk that tightrope. But thanks very much, Casey. As always, very insightful, and thanks very much for joining us.